Good morning, everyone. We'll be starting here in just a couple of minutes. All right, it's 10 o'clock. Let's go ahead and get started here. Thank you all for joining us today. For today's webinar, Navigating Interest Rate Changes and Emerging Risks. My name is David Paxton. I'm a certified community bank risk specialist and the Senior Vice President of Risk Management Solutions at Bankers Bank. I'm excited to be your host for today's session. This program is brought to you by Bankers Bank, the Midwest's leading provider of correspondent banking services to community banks. As an independent source of non-competing financial services, Bankers Bank serves a market of over 600 institutions and provides a strong portfolio of innovative solutions to help our local community banks thrive and focus on the needs of their community. Before we get started, I'd like to cover a few logistics. Due to the number of attendees, your phone lines have been muted. Please submit any questions you have via the chat box, and we'll get to as many as we can at the conclusion of the presentation. We're recording this webinar, and we'll share a copy of it with all of you who were in attendance today. It will also be directed to a short survey at the end of the webinar. Please complete it and share any ideas you have for our future webinar topics. Joining me today is Tom Underkoffler, who's the Chief Investment Officer of Bankers Bank and the head of our investments division. He's been with Bankers Bank for 28 years and is located in our Madison, Wisconsin headquarters. Also joining us is Jim Cluck, who's a member of my risk management team. He's been with Bankers Bank for over 9 years and leads our ALM solution offering called ALM Driver and is also located in our Madison, Wisconsin office. Today's webinar is about planning and change. As with many things in life, change in banking can represent risk. Risk awareness is probably one of the fastest growing responsibilities of today's bank leaders, but with proper planning and positioning, change represents opportunity. Now, for each person on this call, risk and opportunity can look different. So our focus will be to address some of the changes we are facing, explore how to think about these risks and what they pose, consider some changes that can be made, and end with how to best manage it all. To kick things off, I'm going to turn it over to Jim Cluck, who will get us thinking about risk and the change that's underway.
Thank you, Dave. So good morning, everybody. As Dave mentioned, I lead the Bankers Bank's asset liability management program that we offer, and it's called ALM Driver. And my focus for this morning is going to be talking to you about, considering unexpected risks and ways to mitigate those. But first, what we want to do is first kind of put a context to what we're potentially looking at when we're talking about change. And to do that, what I'd like to do is I'd like to begin by taking a quick look back. So we just went through an environment of change. As we all know, during an 18-month period, we saw a pretty significant increasing environment. And in just trying to examine a couple of the unexpected things that we could kind of comment about that, I would say top of the list would be the velocity of the change that we saw. I think we could fairly say that a lot of us were not expecting 75 basis points in succession that were happening during this time frame. I remember 5 years ago and talking about a 100, 200 basis point shock, I would hear feedback like that'll never happen, et cetera. Well, what we experienced were basically mini shocks, potentially within a quarter by quarter look. The second area that I would say was kind of an unexpected change was a shift that we saw in the funding. Now, when I say unexpected, it is because when you look at your interest rate risk models, they have a basic setup from a regulatory standpoint of keeping things static. And what we saw with a very fast rising rate environment, we saw significant shifts in the dynamics of where the funding was going. And from risk, that meant that we weren't following the dollars with the beta settings with non-maturity deposits. We did a jump as far as the interest rate change from a non-maturity deposit to a time deposit. And again, models didn't capture that, which would be an unexpected result as you were looking at your models before that. The other thing that happened also was that it wasn't just the fact that it was happening on the income side, but it happened on the valuation side as well. That shift that happened in the dynamic was actually a shift from a longer duration, typically non-maturity deposit, into a very short duration time deposit. So kind of classify those things as movements that weren't really being reflected as we were looking forward with our models at the time. The third thing that we kind of saw come together was a couple risks kind of converging at the same time. A lot of banks took the positions of mismatching duration and trying to get yield during a very low interest rate environment. Now, that was a risk position that some banks certainly took very conscious positions to take, but then the liquidity risk came in as well, which basically forced potential exposure to valuations that were in the investment portfolios. Something that, unless you considered both of those risks happening at the same time, wasn't necessarily something that would be foreseen very well. But that's what we saw recently with the interest rate rise. But if we want to consider about what is it going to look like with interest rates falling, what can we do? And so for that, we're going to step back a little bit further and take a look at what happened when we saw some downturning environments. So we've had 4 situations where there was some substantial rate decreases that occurred by the Fed, and those were in responses to recession situations. Now, often, as we all know, the inverted curve, it was an indicator of recessions coming up, and we've been in an inverted situation for a little while now. So it seems appropriate to take a look at this and how much did things actually change when the Fed did their moves? So let's go back to the first 2 situations in the early 90s and in the early 2000s. And what we saw was very significant moves, but they were very measured moves. There was a lot of cuts that were occurring, but in none of the situations did we really see cuts that were substantial from the standpoint of greater than 50 basis points. Now, the dot-com situation in the early 2000s, actually, there was a lot of 50 basis point cuts. But if we kind of see what then happened as we take a look at the graphs here on the bottom, the dotted line represents the inverted situation that was in position. And then once the Fed made their cuts, kind of where did the yield curve wind up? And what we can see from both of these situations is that the curve definitely did a non-parallel shift. So again, thinking about our interest rate risk models, we're modeling out what if all rates change down. But when we take a look back, we're certainly seeing non-parallel moves occurring when for the down rate movements of the market. Did that hold true with the later downward moves that we saw? So if we take a look at what happened during the Great Recession, which is very much a hard landing situation, and then during COVID, we see two things. Number one, the cuts got more significant. So now you can contribute that potentially to some various things. Alan Greenspan was in our kind of earlier situations in control. Now Bernanke was in control and was certainly using a lot of levers and very aggressively that they could. And then in the COVID situation, Powell was in charge, is in charge of the Fed and was then. And certainly we saw aggressive moves happening then. Graphically, we see that the short-term rates still are the predominant mover. Less so than what we saw in the other situation. The economic outlook in the Great Recession and with COVID was not as favorable, and so long-term rates certainly saw an impact there. But looking back, we definitely see the fact that it is a non-parallel shift when we see the impact. We'll talk about that when we talk about modeling and how you should be looking at things kind of going forward. So if we want to highlight the unexpected risks that we were seeing from our past lessons and how we can kind of think about that to the future, we can certainly say that aggressive stances and positioning by the Fed should no longer be unexpected. The ups and the downs, 100 and 200, are very real things that we have to be talking about as far as a risk exposure, and we should be planning for that. The other thing, as I mentioned, is the non-parallel aspect of things. It is a requirement within your interest rate risk models that you do a non-parallel environment, at least one. And certainly, I think that we can see from these past activities that they should be actively discussed in your ALCO meetings to say what is the risk exposure to the very short-term nature of potential interest rate changes and what might that look like. Now, that ties into the fact that what we need to be looking at is the balancing of where our balance sheet is as of today. And that is paramount, because where your balance sheet is as of today is not where it was 2-3 years ago. We're seeing in the market some definite trends. Of course, we've already talked about the fact that deposits have gotten much shorter with the move of non-maturity deposits to the CDs, especially in the highly competitive environments, the CD specials. But it's also happening on the asset side. Things have been kind of coming in and getting shorter. Investment portfolio, which our Chief Investment Officer will be talking about in a little bit. We certainly see a lot of people not being active there, and so the durations on those are shrinking. And the loan portfolios as well, something that Dave Paxton, our Chief Risk Officer, is going to be talking about a little bit later on as well, as far as the large reinvestment that's going to be happening within the lending portfolio and the risks associated with that. So with all these changes that are happening in the portfolio, it is certainly imperative to take a look at how the balancing exists and how the non-parallel environments potentially are going to be impacting that. Now, when you to do that within your interest rate risk model, what you're going to often do is you're going to run various scenarios. We're going to, have a twist and we're going to have a turn, and let's see if we stumble upon where potentially some risks may be. And that's certainly effective. But within the ALM driver tool that we have, we can kind of cut to the chase right away. And we do that by looking at key rate duration. Now, key rate duration is a methodology that's well established within the bond industry and for managing overall risk of portfolios there. It is basically a standard. With our software, we partnered with a company that actually came up with the theory of a key rate duration. And the thought process is we can actually apply it to the entire balance sheet to see where our risk is in alignment with the yield curve. So as an example, I have on the screen basically a measurement system of we hold everything steady and we're basically kind of doing sensitivity analysis and shocking each part of the yield curve to come up with an identifier to see where are we going to experience the greatest valuation moves. So it's kind of a way to, like I mentioned, to cut to the chase, to then say, all right, now, if we see stronger movements in the middle part of the curve, how much exposure are we really going to be having for our institution? And it also lets you know that if we do see longer shifts happening, or shifts happening on the longer end because less economic outlook, is that as concerning for the bank because, well, our exposure really isn't out there, so we're not going to see as much risk happening. So that's one way to kind of cut, like I said, get to the point right away as far as where your risk is located with your current balance sheet setup. Another thing that you can do, and we would recommend from a mitigation standpoint to try to understand your risk, is as you look at your risk position, you're going to want to try to tackle it as effectively as possible. Now, we all do well, let's look for things with a shorter duration, and then see what potentially that might do. And we would highly recommend running it through an interest rate risk model. You can do that, of course, for income at any point in time, but for valuation purposes, what you need to do is kind of swap out your current inputs and then re-enter that into the model, and you can see the EVE impact or the valuation impact. With our ALM driver tool and with a couple other models out there that I'm aware of, there is the possibility of doing risk-based approaches. And what do I mean by that? So that would be actually specifying to the model, I want to find something with risk parameters that look like this, or cash flow parameters that look like this. And you enter that into the model will then go through and find the types of instruments that's going to align and get you where you want to be from a risk management standpoint. Technology has come a long way. And it makes your time a lot more efficient if you can have the technology working for you in that sense. So that is something we would certainly recommend using your models or getting a model that can do something from that standpoint to kind of help you manage that area. Now, that is talking about kind of some iterative steps that you can take to try to mitigate some risk that's being identified through a key rate duration assessment or running different non-parallel shocks, excuse me. You're in some situations in some banks out there, you're in a pretty heavy risky situation just based on where things are at. And so one of the things that is part of the risk management basket that you should, toolbox that you should consider is potentially taking hedging positions. Now, oftentimes, especially for community banks, when you think about hedging, you think about that instrument level hedge. You want to get that deal locked down, get it on the books, and so therefore you're going to take a look at finding an interest rate swap, getting floating for fixed, or vice versa, and that way you can not throw off your risk by getting a large relationship in. But if it's a more significant position, one of the things you may want to consider is doing more of a fair value hedge on the asset side or a cash flow hedge on the funding side. But you're dealing with more of a portfolio standpoint, and that involves risk from the standpoint of knowledge and management. When you are looking at like a fair value hedge, you have to be considering putting together a portfolio of loans, monitoring the prepayment, making sure it's constantly in the right position, or you have sufficient coverage. There's different accounting rules. So I would highly recommend that if you're going to be looking at that, you definitely want to partner with an organization that knows what they're doing about that and can help you through that process. Because you can get yourself certainly in trouble by trying to set up your own hedge positions on a portfolio and things getting out of balance quickly and certain other exposures starting to arise. So, but it is a tool and certainly something that should be considered. Now, finally, the last thing I wanted to mention here, as far as unexpected risks and how to look at them, we talked earlier about the fact that we had different risks converging at the same time, and we had a dynamic risk develop because we had a shift from one type of funding into another type of funding in your portfolio. And the only really way to try to capture and identify those unexpected risks are trying to create a scenario that might have that happen. Now, I can hear what you're saying through the muted microphones out there is I don't have a lot of time. We don't want to run iteration after iteration of all the potential scenarios that we could run through. And I agree with that. However, what we can do is incorporate some plausible scenarios to say, we took a look at a situation and we wanted to see what would be happening. And I'm focusing here on lending, liquidity, and funding. So I'm going to throw this up as a quick example. What you can do is you can create a scenario such as we're going to look at a soft landing, or we're going to look at what's going to happen if a really hard recession hits and what might occur. And if you just go through and you start populating a little box to kind of say, here's what we think is happening from an assumption standpoint, from each one of these factors, and then run that situation and see if an unidentified risk is going to start to develop. That would be a recommendation. Again, you're not running 50 scenarios, but a few plausible scenarios about what might happen in the future is important. The other thing that we would want to potentially have you consider is doing one where you're going to have a little bit more severe situation and some harder situations hit. What if we're going to be hit with large credit losses and we're going to be losing funding? Run that through your interest rate risk model, or have your partner help you run those through your interest rate risk model, which we do with the ALM driver program, to really kind of walk through what the implications are to that for you to consider. Now, you'll notice that I've talked about lending, liquidity, funding. These are things that you're not reacting to, but things that are going to be a little bit more out of your control. What I'd like to do now is to turn the session over to our Chief Investment Officer to talk about the investment portfolio, because that piece provides you a little bit more control, and there's a lot of things to think about there. So, Tom, I'll turn it over to you.
No, I appreciate that, Jim. Good morning, everybody. Yes, my name is Tom Underkoffler, and I'll be talking as far as the investment portfolio as a tool, and really a tool that, for bankers is one of those few things that we can do fairly quickly, can do some actionable items. And relative to other changes we can do in the balance sheet, the investment portfolio, we can do things pretty quickly on that. So looking forward to talking a little bit today on some different things on the investment side. Jim brought up some great points as far as wrote down as far as some of the risk mitigation ideas, and really kind of thinking from the perspective of what banks are looking as they look forward. And, one of the things he said, and I wrote down, is preparedness, right? Being prepared and really looking at different tools that we have as bankers available to us to deal with the different interest rate scenarios, right? I mean, he was bringing back some historical scenarios, and some of those, for some of us who've done this a long time, you're like, oh, some of those things. But really being understanding and modeling the impact to our banks in, say, a down rate environment, and changes that, unexpected changes in how we address those on a go-forward basis. Maybe just for, kind of as a gut check for the members of the audience, and again, we can't see you, so, but, so you can raise your hand and yes or no, but a gut check reaction to the FOMC meeting last week. For, a lot of the marketplace, they were expecting a 25. Some were surprised at the FOMC, it did 50 basis points. In your own bank, going around your ELCO table, was there high fives and around happy about of that interest that Fed fund target rate decreased by 50 basis points. Or alternative was a little more nuanced and thinking from your team, what does that mean for our institution? If this path, right, of the Fed starting to cut these rates over the course of 2025, what does that mean for our institution? Is that good? Is that bad? And then when you into the area that closer to my heart as far as for the investment portfolio, how does that impact our bank, right? And I'm guessing just because of the time of year it is, we're all in the middle of our budgeting for 2025, and so kind of the thoughts around all of how all of this will impact our bank, and as we're doing our planning, certainly on the investment portfolio, there's some opportunities there for taking actionable items on helping the balance sheet on a go forward basis. So if you were to poll your team, okay, if you're going around your ELCO table, what are you more concerned about in 2025? What are you thinking about from your bank perspective? Is it a little more of the 2023 items, which is really, 2023, 2024 was really looking at the continued pressure on cost of funds, right? We were looking at increased funding costs, what that means for our balance sheet. There was a lot of attention for a lot of banks over the course of that compression of the margin side. Is that kind of trend, even with the Fed coming down, is that going to continue on? You could make an argument that, yeah, hey, there's kind of that market implication of the Fed fund target rate going on, but very likely for a lot of the banks on this call, that's not a one-for-one consideration for you, right? I mean, there's going to continue to be competition, for example, from money market funds, continued competition from other players in your marketplace. Throw them under the bus. Maybe a credit union doing on-market rate CD specials and those sort of things that make the competition that you won't have that kind of one-to-one movement with the Fed funds. So is it going to be a little bit in 2025, a little bit more of the same story we've seen over the course of 23, 2024? There's also the thought around as far as rising yields, right? And particularly more rising yields in kind of that mid to the long end of the curve. And that was more the story from the investment side in the course of 23, 24, where banks were saying, why are we adding to that part of our portfolio right now when it seems like, that part is where the pressure is? It seems like we're allocating if we allocate to that part of the curve right now, we're going to continue to have, additional losses in the portfolio. We're increasing that AOCI, the accumulated other comprehensive income. And, we're getting pushback. Why are we adding to that by adding on the portfolio? And the other component was, right, that you were paid more to sit in cash, sit on the short end, short-term assets, higher yields on that part of the curve. And so an indication of that. So, with that change, is from your bank's perspective, as you're looking at that and concerned about 2025, is there a shift to kind of the philosophy of the bank as you look for the portfolio in 2025? Alternatively, and those banks, I think I would say, are probably moving on the liability sensitive side, but for those banks more on the asset sensitive side, I think there's probably more consideration, and at least talking about now in 2025, the pressure on the net interest income, and primarily thinking about that through the lens of, loan income decreasing, whether either through repricing, now that, prime just decreased, or say timing of those refinancing options on the loan portfolio, how those will impact, right? And as far as for the pressure on that net interest income. The other side being, there's falling rates on the short end of the curve. And for those banks that had positioned themselves on that short end of the curve, more in cash like securities, Fed funds sold, having a fair amount of that balance, they can, as the Fed, and if they continue the path of decreasing those short-term rates, that they're going to see some pressure on the net interest income on the short ends on that side. So like scouts, we like the idea that, let's be prepared. Let's have some planning perspective of, what we can do. And particularly with the investment portfolio, there's some options to how you can address that. Now, we talk to a lot of banks. The team talks to a lot of banks. We're invited into investment committee meetings. We're invited, to participate in ELCO meetings, even invited in some cases to meet with boards of directors and kind of, what's the perspective we're seeing across the banks that we work with and in the marketplace, what's going on in the investment world. We always started from the perspective of looking at the objectives of the bank, not necessarily just the bond portfolio as a whole, but the overall objectives of the bank and really how they utilize the investment portfolio as part of that on the bank side. Oftentimes the discussion side, and we keep it simple, right? I mean, the easiest way to look at that as far as objectives in the bank is for the portfolio is really three things. And we talk about certainly on the earnings side, and that's really around the net interest income objectives. And really being thoughtful and kind of those expectations that the bank has. What's kind of the allocation that they're expecting to get out of the investment portfolio for that net interest income. And that's really an important part of, kind of the setting the stage of it. Because let's face it, I mean, that's the real dollars in play on that. But I could also make a pretty strong argument that the liquidity component that the investment portfolio has an objective and the interest rate risk management side are also very important. And I would say probably proven out by the last couple of years, the importance of them for a lot of banks. The investment portfolio is a component of that liquidity. Understanding that is as part of that, the access to liquidity from the portfolio, the ability to potentially sell part of the portfolio, cash flows, the ability to pledge, all of those have become much more into play. The other side is really the portfolio as an interest rate risk measurement or interest rate risk management tool that the bank can utilize. And again, kind of going toward that effectiveness and kind of the quick ability to make some changes that the investment portfolio can do. To highlight that and be a little more specific on that, kind of from that interest rate risk management side, is really kind of how we manage from factors on capital, right, and important to us as banks. And for the attendees on this call, it's not as much as capital metrics and per se, but it's really been lately the considerations around access to liquidity, right, and the investment portfolio as sources to to access different sources of liquidity, whether from advances or utilizing the securities portfolio from sales, but also kind of how to reduce and liquidity sources in reduction from investment losses. The other piece too is kind of those cash flow aspects and understanding from a portfolio perspective, what you can anticipate from prepayments in the downward rate environment or extensions coming in a rising interest rate environment, and really understanding the cash flows. Historically favor, somewhat understanding more bullet-like cash flows and just kind of the reliance and availability on that. But let's face it, there's more complexity on some of the bonds that banks are purchasing, and understanding and having robust modeling of that, better understand the cash flows that the bank can predict is really, really important. And finally, coming back to the earnings side and understanding kind of the net interest income changes the bank has, really looking at the investment portfolio. The idea being that, the investment portfolio, fixed income, right? Fixed income portfolio is more fixed part of the balance sheet. And as such, as a tool, it's maybe more fixed as far as in a changing rate environment, what you have, and protecting some of the net interest income that the bank is producing. That's a component where the investment portfolio can assist. One of the things, and many of you on this call are familiar with this, and this is a part of our analytics package that we provide to our banks. If you're a portfolio accounting customer, we're pulling in information and providing here, pretty statistically decent dispersion of different portfolios among the different banks that are working with us. I think the key point here that I would say is not so much that, you're looking at peer or kind of where your bank is as far as, relative amount of return in the yield, relative amount of risk measured in duration, but it's kind of this idea that where does your bank want to be, right? Where do you want to go as far as, we want to be, this kind of duration of a bank, or we want to be this sort of yield on that. And then taking a look at kind of what are those portfolios, how are they constructed in such a way that you understand, for example, why they're getting the returns that they are, and the duration, the risk metric that they have. I think the key thing I would like to stress on that is that portfolios can be changed, right? I mean, again, we're talking about actionable items. If there's something that you want to change in the portfolio, there are certainly actionable strategies that you can change to change the risk and return components of the portfolio. Understand that you have that available. And I'm going to pause here just on a soapbox. I think it's really important for all attendees to have some sort of analytics piece that you're doing on the investment portfolio, whether you're using our system or using another system. It's extremely important, I think, at that securities level, understanding the dynamics for different interest rate changes. What are the impacts on the bonds? Because as portfolios have some complexities based upon kind of the types of securities they have, it's really important to have that robust modeling of those securities. Again, it's kind of the preparedness that Jim had brought up in the on the ALM side. When we're talking as far as the dynamic investment portfolio, really think about it kind of in two steps. And I think probably step one is really thinking about what targeted security sales. This is kind of the prepare step, is saying, if there is an opportunity out there, right? If the factors in the marketplace make it attractive for us to sell a security, identifying that on the front end, I think, is really important to do. And then from that, once you have it kind of identified, which potentially securities you would like to sell, there's the idea of a bond swap. And we're going to run through just kind of a quick example of that, why you might do that, why other banks are doing that, but kind of as a quick example to kind of show that there's economic perspective of why you would do that, but also other considerations that you might take as you're doing that type of exercise. So targeted security sales, I'll say, okay, the last, couple of years have been probably more so for all of our banks, and kind of the impact on our portfolio has been more macro level. And these are things I would say, when you're talking about inflation or monetary policy, like what the Fed is doing as far as changing those rates, those type of things are out of our control. But there's different things that we can do as far as mitigation of risk, planning for those risks. But those are more out of our control, right? I will say, that's true for all bond portfolio managers, right? But we are not just bond portfolio managers, right? On this call, I mean, we're all also running banks. We have bank balance sheets. We have different factors as far as how we support our loan portfolio, how we look at for kind of our loan growth, how we look at different factors, what is our ability to raise deposits locally, and how do we raise our core deposits. And it's really this kind of variables in the banking cycle, kind of our local aspect, that really becomes a little bit different mix when you're managing a bank investment portfolio than just managing a bond portfolio. Okay. And so when you're thinking about kind of your needs and kind of where you're at, it might be credit from the perspective like, well, we have exposures already from our bank perspective. We don't need to add any more of that. Or it could be that we want more exposures because of the nature of our current lending, our customer base, that we want to change that and get some diversification from the investment portfolio. The other side being kind of on the deposit side. Again, this is kind of the funding side, utilizing the bank portfolio for those different exercises that can all come into play, and utilizing the investment portfolio. Here are some examples of why banks, as you pull data from publicly traded banks, why they looked at bond swaps and selling securities. A lot of these, I think, pretty straightforward for a lot of us. Some of it, again, I think cash was an interesting as a component, again, kind of moving that, shortening the asset mix to shorter assets. But really the idea, and what we're going to run through just a fast example, is this idea of reinvesting in higher yielding securities through the idea of doing a bond swap, okay? Taking a lower yielding security in the portfolio and swapping it into something else. Most of you in the call are familiar with the kind of the general concept of a bond swap, but I want to leave with just really 4 items when thinking about that. It's really important to look at the earn back period to offset the time frame on that loss. Also looking at, we talked about the security selection, what you may choose as far as the security. It may have other components, just the economic perspective, but it might also be security selection on where it fits as far as the economic value of doing the swap. That economic value right now, and again, for an actionable item that for the listeners on this, is this idea right now that the earn back period on, say, a lower duration security, you sell that right now. As we start to have the yield curve normalizing and you're getting compensated for going out longer on the yield curve, that there is some more economic value for selling a security at a loss. Okay, we're going to run through an example of that. And then this idea of bond swap now or later. We'll talk about that. And that's kind of the key thing right now is well, why don't I just wait for this bond to mature off and not take the loss? But you have to run the kind of the economics. Do you get enough gain from adding income from putting on the new investment? Okay. So just context wise, bonds have moved down since the end of second quarter. No surprise there to today. Pretty significant. And what's important here for our analysis is in the 2-year, we're down 82 basis points. 5 years down only 54. Okay, bigger movement on the short end. One comment, of course, is that really interesting to some of us is that actually rates have come up since that Fed cut in September. So some of this, the economic value has shifted, and that's kind of this preparedness idea to be ready for these different opportunities. Our system, we can pull into our bond swap system. It's really easy if you're on our accounting system, on our analytics system. We can pull in different scenarios. We can identify just out of the portfolio, impact to the portfolio by selecting the bond that you have. We have a real-time example of a portfolio that works with us. We selected a bond, $5 million of a U.S. Treasury note. It's due in January of 26 with a yield of 1.74, and ran through the scenario of putting on pretty much as we could, maybe a little bit longer, but still a very conservative option as far as cash flow and timeframes, but really putting on what is the impact of selling that U.S. Treasury and buying a callable agency, 5-year maturity, 3 years of call protection, one-time call. If not called in 3 years, then it's non-callable. That's yielding 405. Run through the analysis of that scenario where we say, okay, we're going to realize a $129,000 loss, and it takes about just a little over a year for that break even on that loss. Why you would do this is really, it comes down to the, basically credit is essentially unchanged. The portfolio duration is relatively unchanged. Why you would do it is the increase in annual interest income. That's increasing by $71,000. So even though this is not huge economic benefits, it's a fairly conservative example. It's also something to have as far as kind of understanding that there are some benefits to that. Some bond swap considerations is you have to understand that there's some impacts to capital when you take that loss, kind of the impact to the earnings side as far as maybe additional enhancements to the earnings, accounting implications. If you already have marked from HTM, you want to have some considerations around there. And really, if there's some tax considerations on that side. So really, I mean, in summary, there's a lot of considerations and opportunities with the investment portfolio, particularly if we do have a continued falling rate environment, kind of thoughts around where you might want to be as far as yield curve positioning, and really the selection of those securities, where it's most advantageous for your bank, given your objectives on that. Okay. From that, I'm going to switch it over to Dave Paxton. He's going to bring this all together as far as for the holistic view, utilize enterprise risk management, even beyond just having the interest rate and the investment portfolio perspective.
Thank you, Tom. Yeah, so let's talk about the big picture, which is enterprise risk management. It's kind of the buzzword in financial services right now. And I'll show you why it should be something that you could implement and should implement in your banks as well. So let's start talking about what enterprise risk management is. It captures more risk than standard reports. You already do risk reporting to your ALCO, you do risk reporting to your credit committees, but you're not capturing the whole picture when it comes to risks and how risks move throughout the organization, because many things can change at the same time. We're well aware of that. Interest rate risk changing, our customers, our credit borrowing, our portfolios are changing. Everything changes and it affects something else within the organization. And you need to be prepared to see those changes in real time. You should monitor emerging risks. We just talked about emerging risk here for the last 45 minutes. And so we need to be able to model those risks and monitor those through enterprise risk management. Risk measures need weights to be effective. That's a very important point. Your teller overages are not nearly as important to you as your credit portfolio. So you want to make sure whenever you monitor risk through enterprise risk management, you're effectively weighting the risks, and the most important risks have the highest weight within your organization. And finally, the most important part of enterprise risk management is it's important to compare your risk scores to your tolerances. If you see a risk score, let's take a hypothetical 1.5 as your risk score. What is your risk tolerance? Is your risk tolerance a 1.0? Is it a 2.5? Unless you know your risk tolerances and you can compare those risks against your tolerances, you're not really doing risk management. You're basically just getting some data that you have to make some spur of the moment decisions on based on what you're seeing. This is the Enterprise Risk Management Dashboard. Bankers Bank has built this for ourselves, and we partnered with a local firm to do this for us. It's also available to our customers. So if you see what you like here, just reach out and let us know. We'll be happy to go into more detail with this. But basically, I want to use this to show you what enterprise risk management and good risk scoring and good risk reporting would look like. So for example, this is our hypothetical bank of demo in Q3 of 2024. We'll just say that this is where they are today. They're in a pretty good spot. Their enterprise risk score is a 1.5. Again, talking about our risk tolerances, how is a 1.5 compared to our risk tolerances as an enterprise risk score altogether? We can see that our risk appetite is a 2.1. We're only using 71% of the risk appetite at this particular bank. So we know that overall, based on our risk categories, all the risk indicators that are the key risk indicators that are going into this, the roll-up says that overall the bank is doing quite well. Also within our dashboard, we have risk broken out into risk categories. These are the 7 risk categories that are recommended by the OCC. We try to follow the regulatory guidance as much as possible with our risk platform. And I would suggest also when you're looking at risk management, you're using these risk categories as well, because those are from the regulatory guidance. These risk categories each have a total risk score compared against their risk appetite. So not only do you have an overall risk score for your organization and comparing it against your risk appetite, you can really get into these risk categories, the 7 that we have here listed, and compare those overall risk scores compared to our risk appetites in each of those individual risk categories. Each of these risk categories has its own weight. Remember what we said previous, you have to have higher weights for risks that are higher in meaning to you than others. In our example here, we have our credit's getting 30% of the total weight of the organization. Liquidity is very important to this bank, so they've rated it higher than the rest. And over time, your risk might change. And so it's very important to keep visiting your enterprise risk management weightings whenever liquidity becomes less crucial to you. And let's say that reputational risk gets a little higher. Enterprise risk management is not static. So therefore, you need to make sure that you're updating your risk program very regularly. Within each of these risk measures, there are 2 kinds of risks. Risks that can be measured. These are risks that can be measured either from real world numbers from your UBPR. They could be things that you provide to your credit committee. These could be your ALCO reports or your ALM reporting. There's also risks that don't have real tangible numbers associated with those. And that's your quality of risk management. These are your intangible risks, but are also important to understanding the risk within your organization. I like to use the example when I talk to customers. If your chief risk officer or if your chief credit officer won the lottery and decided they weren't coming into work anymore, and they'd been with your bank for 20 years, your credit quality isn't instantaneously going to get worse through your tangible, measurable numbers. But subjectively, you know that now you have a much higher risk in your credit area, and you need to be able to handle that risk. So it's important whenever you factor in risk management in your risk measures that you do take some subjective risks. You don't have to rate those as highly, but you should be incorporating those into your factors as well. See risk over time. So for our example here, we're going to go over 3 quarters, our current quarter plus 2 in the future. So whenever you see risk over time, you should be able to easily see which direction the risk is headed in. And also you should have access to prior history, because you want to not only sanity check your current condition in risk, but you want to see what the risks were a year ago and how well did you handle those. So let's go to our hypothetical bank here again in Q3 2024. Again, they're managing their risk quite well compared to their risk appetite. Let's fast forward now 1 quarter. And let's say that economic conditions aren't quite as well as they are now. We're not headed to a recession, but the economic slowdown has happened. Rates have either stabilized or maybe even dropped some. However, let's remember what's on the horizon for future risk and emerging risk. We've got a huge portfolio of credit that is going to refinance at a much higher rate, and your borrowers are going to have some diminished repayment capacity. There's still going to be some competition for funds, so cost of funds is going to continue to be higher. You're going to have to fund your balance sheet, and so therefore you might have to pay up to do that. These are all real-world situations. Using enterprise risk management, we can see that this risk, this emerging risk we see, is increasing for this particular bank. They're using enterprise risk management, so they know that risk is increasing, and they're going to have to make some management plans to address that. Now let's move forward 1 more quarter to Q1 2025. And so now we have increased economic risk that's going on within our organization. We also have, some more economic factors that might be coming into the equation. More and more of our risk is being enhanced by our borrower's condition. And also we have some deterioration in our credit concentrations that we didn't factor in originally. So let's look at our risk categories here within our example. And as we can see, we went from having no flags for our previous quarter to now all of a sudden the dashboard looks like it lit up like a Christmas tree. And we can see now where the key points are easily within our dashboard to see where we need to pay the most attention to with our efforts within. We can see here in the credit portfolio, we have a yellow flag in the total risk category, and we also have a red flag for our measurable risk in those categories as well. So we need to pay some particular attention to our credit risk because our quality of risk management isn't good enough to overcome our problems that's going on in our measurable risk areas. We can also see here that, remember what we said, risks move in tandem and risk could be throughout the organization. We also have a yellow flag in our quality of risk management for our strategic risk. And we also have a red flag in our measurable risk for reputational risk, which is a huge problem for banks. If your reputation isn't any good, it's going to bleed into other areas within the organization as well. So here we can see on our graph, risk over time has continued to increase. So this bank needs to do some pretty important, needs to do a lot of work in order to get this risk back under control. Now, imagine for a second that you didn't have enterprise risk management and these risks are increasing. How many quarters into the future would they have finally noticed something and maybe it was too late to make some changes? So if we look at our Q3 2024 credit risk, well, let's look at the attributes. And so attributes are things that we want to measure within our organization. So here we can see some examples of the attributes like our portfolio asset quality, our ACL funding, our credit capital exposure, our concentrations. It's important also to measure economic factors as well, because economic factors are external risks that you can't control, but they directly impact the risk within your organization because it impacts your borrower's ability to repay as agreed. So we can go forward one quarter now to Q4 of 2024, and we can see our economic factors are giving us a warning here that some things might deteriorate in our borrower's ability to repay their loans as agreed. We go forward one more quarter in Q1 2025. Our risk tolerances have been exceeded in our portfolio asset quality, and our economic factors are continuing to worry us as well based on what we're seeing. If we look over here to the left side of the screen as well, you can see that the same flags we were seeing on the main dashboard are telling us that the economic factors, some of the portfolio asset quality is starting to affect our strategic progress and also how customers are going to see us as an institution and be able to manage their finances. So let's dive a little bit deeper and go into what we call the key risk indicators of our customer. And we're just going to stay in credit because credit's near and dear to most people's hearts. So let's talk about this example here of multifamily capital exposure. So now what we're talking about is really getting deep into the data that make up not only the risk attribute, but also the risk category that roll up into the enterprise risk score. So we're kind of drilling into the bedrock of risk data here, but it's important to know what goes into the factoring. And using Enterprise Risk Manager, you should be able to easily find real-world data that lives within your enterprise risk management structure so that you can really drill into what is causing the heartburn of risk within your organization. So for this example, let's look at multifamily capital. We can see that we're slightly over our risk score here. And again, we're talking about Q3 of 2024. So at the beginning of our story here, this bank already has some stresses in their multifamily capital exposure. We can see they've rated this risk very highly on the weighting. This is our real world number, 128%. Now, where does 128% fit within our benchmarks? Here we can see our benchmarks to the right. We can see where that would fit within our risk categories based on very low, low, medium, high, and very high. So now we can see where those are in the real world based on what we're seeing. Another example here is our CRE concentration. We can see here again at our current state, we can see that we're already exceeding our policy for CRE concentration. Again, we're not using any real banks, so don't worry. This is no one in particular. So you can see that this bank has exceeded their CRE concentration for their policy limits already at this point, and they've rated this risk very high as well. Again, here's our real world number. We should be able to verify your real world number within your risk structure and be able to find that and compare it against your benchmarks. To look at another risk category, let's look at interest rate risk. And so you can see some of the attributes here. You can also see the rating compared to our risk appetites. If we look at our example bank here, they already have some stresses. Going back to Jim's presentation, they already have some stresses in their 2-year net interest income at the 400 basis rate shock. So they're already outside of policy. So that's something important that they should know about. And again, we can compare that to our benchmarks as well. To touch into another risk category here, strategic risk, you should be measuring strategic risk at your bank. If you're not, you're really not getting the big picture on how risk flows through your organization, because at the end of the day, strategic risk is very important, because if you don't understand how risk is impacting your strategy, it could come back to bite you in a big way. And then finally, reputational risk is very important as well, because that's how your customers perceive you. And you should really come up with some really good key risk indicators on how your customers perceive you as a financial institution. So going back to our main dashboard here, again, looking through how things can change over just 2 quarters. We can go from a 1.5 low risk, happy-go-lucky bank to a moderate risk very quickly with risk flags going on. And here we can see just how much that has impacted our bank. So to wrap this up, enterprise risks do change over time. There's changes from external pressures, your market pressures, your competitors, your regulators. There's also changes to your internal processes. If you have new staff, you have new business lines, you have new branches and such that you have to worry about. Those are internal processes, and you should be measuring the risks with those. Also, changes to strategy. How has your strategy changed since you implemented your risk management plan? And are you prepared to deal with those? And are you monitoring it effectively? So if you're not monitoring it effectively, then you're really not doing enterprise risk management. You should know exactly where your risks are at any given time so you can plan for the future. I'll leave you with this thought here for ERM. It's a good plan executed today is better than an excellent plan that is executed too late. I'm looking at you, Silicon Valley Bank. Jim, did we have any questions that came in on the chat?
Dave, thank you very much. There are a couple questions, but in light of the fact that we're about 2 minutes to the top of the hour, we'll just commit to providing, along with the materials after this, those questions and the responses that we have to those. So Dave, I'll turn it back to you for closing thoughts.
Perfect. Thank you. Well, it's been great having everyone here today. I really hope that you got some good information about risks in the near future and what Bankers Bank can offer you in terms of assistance in handling those risks. We look forward to your survey replies, which will help us create our next quarterly webinar, and look for recording this webinar coming to you soon. I want to thank you all again for coming today, and have a great day.